Hello, this is Scott Bear here at Mortgage Pro. I'm part of your real estate success team here at Realty Pro, and I am here to make you successful. I wanted to make sure and make you aware of some new things that have come out recently, very important. Feel free to forward this video to your clients. We'll give them a lot of great information as to what the economy is doing right now, what the Fed is doing right now, and how it will affect home loan rates now and in the near future. Very important information. The Fed is beginning, and has already begun, a new purchase program of Treasury securities. They will be buying $600 billion in Treasury securities through the end of June of 2011. Now, this does not include any Treasury purchases that they will be making with the proceeds that they will be receiving on their current mortgage-backed securities portfolio. Including that money, they will also be purchasing about another $35 billion per month. So all in all, they will be purchasing about up to pretty close to about $1 trillion in securities purchases through the end of June of 2011. That is a lot of buying. Now, this is the second buying program that they've enacted. The first one was called QE1. This one's called QE2. QE stands for quantitative easing. It's just a little term that they've coined. Now, the second buying program that I'm talking about right now, there are three reasons as to why they are doing this. One, to create inflation. Now, yes, right now we have had inflation, a little, very slight amount, but it is at a rate that is much less than the Fed is comfortable with, way too close to deflation. They do not want to see a double dip. So they are trying to actually create inflation. Second thing that they are trying to accomplish is they want to create an economic boost, thereby lowering the unemployment rate and increasing jobs. The third thing, they would like to increase the price of stocks, create that economy, make sure that inflation is taking place, or at least a greater inflation rate. Now, keep in mind, the most important thing about these three things is that they create headwinds against mortgage-backed securities and home loan rates, okay? Resistance. That means home loan rates we should see going up in the near and further future. I want to show you what's going on in the past week. See that circle there on the right? That is the mortgage-backed securities pricing that has taken place in the past week. It has plummeted. When mortgage-backed securities pricing goes down, home loan rates go up. And we've seen that occurring in the past week. The rates have risen. Now, this is on account of what the Fed has been doing. So we need to make sure that our clients understand this fact, and that the environment that the Fed is creating right now should increase mortgage rates, most likely, and they should be taking advantage of the current times right now, locking in their interest rates and securing for themselves the fantastic rates that we have right now. Now, I want to also mention a little bit about the jobs that have been created, or should hopefully be created by what the Fed is doing. The Fed has released a statement basically saying that they're going to be watching the market very closely and adjusting their purchase program likewise, so that they can create maximum employment. Now, I want to show you a little bit about what the jobs have been doing. There was an estimate of 60,000 jobs that were going to be created in the private sector. Now, that estimate was completely blown out of the water. They created 151,000 jobs in the private sector. That is a fantastic number. Now, to add to this positive tone, there were upward revisions to the jobs lost in August and September. There were 110,000 jobs fewer that were lost in that time period. That's great news. To add to that, average hourly earnings increased by 0.2%. Average work week, it rose to 34.3 hours. All these increases were greater than expected, much stronger. And if we see these trends continue, we will be able to support the notion that not only is the labor market stabilizing, but it very well could be expanding and increasing. That would be fantastic. Now, we need to also keep in mind that this, of course, along with the other two reasons the Fed is enacting this purchase program, is creating headwinds for mortgage-backed securities and home loan rates. We should continue to see those rates on the rise. So let's lock in those rates. Yes, they will fluctuate in the very short term like they always do, but in the long term, we should be seeing, most likely, mortgage rates on the rise. We need to make sure our clients are aware of this. So that's about all there is for the news right now. Wanted to make sure you had this before the end of the weekend. Make it a successful weekend, and we will talk to you very soon. Bye bye.